Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch this week. I'm Ntaoleng Lechela, and joining me to unpack your stock-related questions today via Zoom is Chantal Marx from FNB Wealth and Investments and Graeme Körner from Körner Perspective. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X at Business Day TV using the hashtag Stockwatch. Chantal, Graeme, thanks so much for your time this afternoon. Maybe let's start off with a general markets action and looking at what we've been seeing in equity markets. There's been, a bit of a pullback with US markets, European markets pulling back from those record highs we saw sometime last week. Some volatility coming through as investors mull over tech stock valuations. There's been, concern around a tech bubble. Are you tracking that, Graeme? One might argue that valuations are warranted looking at earnings growth.
That's telling the million-dollar question, whether this time is different, because I think the business case for a lot of them, even the Mag 7, which are on lofty multiples, it's different to say the dot-com bubble where people were paying times 6 and other sort of crazy metrics. So you sort of feel that the business model for businesses like NVIDIA and Microsoft are very different to what we had during the dot-com bubble. But I think the thing that I'm really wrestling with is if you take the forecast, everything looks great. And I mean, NVIDIA, for example, they really do have a clear runway for some time. But the question that I'm asking myself is to what extent are we maybe overestimating the fact that everybody is going to be a winner, and that if we're overestimating the earnings growth, and that is basically what is sustaining the market where it has been and these valuations, I think that for me is the big challenge. So I don't think we're going to necessarily see an apocalyptic sell-off, but I think what we're seeing is the market wrestling with the fundamentals. And up until now, it's been a case of if you were AI driven, even if only part of your business model was AI inspired, the market got very excited. And I think that what's happening now is a logical recalibration where people are really trying to ask themselves who the real winners are and what sort of multiple you can pay on that. So it's a time for sort of reflection, I suppose, is the question.
And talking about that reflection, Graeme mentions that there are going to be those real winners, and some won't, post as much gains as the others, right? Then, Chantal, what we've been seeing some traders, some investors doing, punting a lot of short selling. In particular, Palantir comes to mind. And I was watching Stockwatch last night, and it seemed like analysts are not too sold on Palantir. Rikus Reed has even said that the earnings growth we are currently seeing is as a result of a low tax rate. And when that changes, it'll paint a very different financial picture. Is that a counter that you think perhaps is more of a trading stock?
Not necessarily. It's very complicated with Palantir because I think that the service that they're offering is really great. I think what they've done in terms of defense and even on the commercial side has been groundbreaking. They've been an early winner on the solution side when it comes to integrating AI into businesses and government. The problem with Palantir is just that the valuation has completely run ahead of itself. So it's going to take you a decade of growth to actually justify the valuation that you are seeing right now. Or growth is going to have to take a meaningful further step up, which is going to be very difficult off a larger base, right? So I think that brings that into question. I don't necessarily see Palantir within that speculative tech basket. I think it's probably one of the early winners. But you've definitely seen a lot more pressure on companies that are seemingly overvalued from a fundamental valuation perspective, as well as true speculative tech. So the guys who aren't making any money yet, but they've got really great ideas and awesome kind of investor days. So yeah, I mean, it's difficult with Palantir. I like the company fundamentally. I just think it's just still too expensive, and that this correction is probably warranted.
And just sticking with you then, Chantal, a question here. I hold shares in the Magnificent Seven companies and have managed to generate profits between 30 to 150% in some of the shares. Would the panel suggest that I should take some profits at these levels or leave the profits in the companies concerned?
So I think it depends on which companies you are looking at. Some of the companies in the Mag 7, I think notably Tesla, I would consider to be more of a trading stock. So there I would regularly look at my gains and probably trim some losses. The rest of them, I think you can comfortably hold from a longer term perspective, but you need to also look at it in the context of your broader portfolio. If it starts making up a big chunk of your portfolio, it's always a good idea to trim a little bit of those profits and perhaps look for opportunities where there's value elsewhere. You want to be diversified in any market, and an AI booming market is absolutely no different. You would have been quite hurt over the last week if you had an extremely big allocation to just that sector.
And what about you then, Graeme, when it comes to those Magnificent Seven counters? Would you take some stocks at these levels? Chantal there mentioned Tesla, and I'm thinking of that $1 trillion pay package that was approved. Elon Musk proving to be even richer.
Yeah, well, the proof will be in the pudding. I think there's a few KPIs that need to be satisfied. But I think, touching on what Chantal was saying, I think you've got to ask yourself why you're in the Mag 7. So if it was a speculative, I think there's an opportunity in technology and you really were just looking to put some money to work for a season, I would probably take a little off the table. But if it was sort of part of a more diversified strategy, then you could probably argue to run it. I think the important thing to remember is if you look at the Mag 7, obviously the top 10 in the S&P 500 is historically out of bounds from what they traditionally would have been. So, almost every investor who's got S&P 500 or MSCI World exposure has actually got quite a lot of exposure to the Mag 7 already. I would agree with Chantal. I think Tesla for me is one of those, it's a hero or zero kind of stock. I know people that absolutely love it and say, cars are secondary to AI and robots, that are going to be their real future. If I look at a company like Microsoft, which we hold for clients, I think it's a great business, but personally, I think the multiple for what you're going to probably realistically see over the next 2 or 3 years is overcooked. So, on balance, you probably on most of the Mag 7, you're looking at sort of mid-teens, probably on just a simple average earnings growth. That's not to be sneezed at, pretty decent. The problem is the multiples, on pegs of over 2 times often. So I think that for me is the challenge. But I would agree, out of all of them, I think Tesla is probably the most volatile and the one that probably has the most to give back. Bearing in mind, there's a big bet on AI quite directly in Musk's world. But I think if I may just add, companies like Amazon, they've got real business cases, Meta, and there's an argument to say that Meta may very well be, making massive progress in the content war. So, there's lots of different moving parts. What we're tending to do is there's this AI theme, and all of them generally have a little bit of a tailwind courtesy of AI, but it's not they're not all going to benefit equally, if that makes sense. So I think you've got to ask yourself, what do you like about the business model of the Mag 7? And if you don't like anything, or you think it's vaporous or unpredictable, then you probably want to get out.
And bringing it back home, a viewer looking to add local tech to their portfolio and asking what you would suggest, Graeme. They've listed the likes of a data tech, Altron, or perhaps an ETF.
Yeah, look, I mean, the South African technology space we're not exactly spoiled for choices. It's one of the arguments for, internationalization. Data tech, I must be honest, I've always looked at it and thought, with Westcon and Logicalis, it's a really decent business and just never pulled the trigger, quite frankly. So I think data tech has been doing a really good job at executing. and diversifying and de-risking the business model. I think Altron seems to be going through a little bit of a difficult phase, but some very interesting businesses there. But I mean, if you look at the technology sector in South Africa, I mean, just really, it's Naspers and Prosus that kind of dominate, and everything else is a secondary afterthought. But I think data tech is a good business. But then I would ask the question, the South African technology space is so small. What is drawing you to it? And is there not maybe an opportunity to invest in something internationally that will give you even better exposure? But I think data tech, in answer to the question, looks like a really good business.
Chantal, there's also a likes of a Bytes, right? That group going through some hiccups, but of course has a strong pipeline and still likely to benefit from its partnership with Microsoft. Where are you seeing opportunity on that front, or would you rather go with the goodie Naspers Prosus?
Yeah, I mean, so I would definitely have Naspers or Prosus or even both in my portfolio. I do see still significant growth runway there, and it's probably your best kind of JSE direct company exposure into that broader thematic. Bytes kind of falls in the same category as Ayoko and some of the others in that they're software resellers, so they're very dependent on the relationships that they have. You are going to get some bumps in the road, as you did right now. It's not really groundbreaking or exciting from my perspective. Where I do see a lot of opportunity, though, is in fintech in the South African space. I think we do it really well. We execute exceptionally well on the fintech side. So I would have exposure to companies like Capital Appreciation and Optasia, the recent listing I really like as well. A very creative problem that is being solved there. Then Altron and Lusaka has some fintech exposure as well, probably a little bit more diluted relative to the rest. And then I think that there's a real opportunity that we're going to see more fintech coming to the JSE. So I think a lot of the big companies like Vodacom, like MTN, like Pepkor have growing and substantial fintech businesses that could potentially make a big difference from a tech sector perspective in the South African context. So maybe wait for that as well. And then the other one, before I forget, Old Weaver Fintech.
Oh, yes, Home Choice.
Giving out catalogs to people to buy blankets. And I mean, now they're one of the biggest fintech players on the local market. So I think that is a space where we have a competitive advantage, where we're really bringing interesting ideas forward. And it'll probably be my preference for tech exposure on top of Naspers and Prosus.
Let's stay in that fintech space we were talking about. There's a question here, Graeme, on Optasia. Viewer asking which companies are in this type of business around the world.
Well, it's an interesting question. I mean, if you look at a company like New Holdings, for example, if you're looking for sort of digital banking, business that we quite like is Time, the Time Global thing. Obviously, in SA they're tying up with Sanlam, so I think they look quite good. Chantal was mentioned with Lusaka with Bank One. So I suppose it depends what you're looking for. But in terms of mobile money and digital banking, I think Optasia looks very, very well placed. If you look underlying MNO clients and I suppose peripheral banking clients, and something like 700 million, and I think active clients is over 100 million. So for me, Optasia really does stand out. I think New, if you're looking for the disruptive banking model. But as I say, I mean, we've been exposed to Optasia for quite a long time, and it's been like a 7-year pregnancy in Ethos Capital. Finally, it seems to be coming right.
Yeah.
But we also had exposure through African Rainbow Capital and still do, with Time. So I think Time is quite an interesting asset. But if you're looking at sort of disruptive tech, I'll yield to Chantal in terms of all the players that you can look at internationally.
Okay, let's get into that conversation then. What other companies operate in the similar space as an Optasia?
So, I mean, broadly, fintech I would say, but what Optasia does is actually quite unique, which is one of the reasons we quite like the stock. They've got one or two competitors in the broader African space, but I think it's important to understand what exactly Optasia does to make sense of why it's so unique. So they basically have end clients who have a mobile phone. They are, for example, an MTN or Vodacom client. They are looking for an airtime advance, or they are looking for a microloan of $5 on average, right? That is not it's not a big loan. The bank does not want to grant anyone a loan of that size, particularly not for a short period of time, looking at like 7 days to 30 days. It doesn't make administrative sense. It doesn't make financial sense for the banks to do this. So what Optasia effectively does is that they screen the client with using their AI models, using all the data that they have available to them, to check if this client is a good person to lend money to in that way. And then they actually take on the risk of lending that money to the client. So they have it's kind of like a black box in between the mobile operator and the bank, but you need scale, you need the relationships, and you need the balance sheet, as well as the data and the ability to process that data effectively. And I think that that's what makes them quite unique in this space. It'll be very difficult, I think, for a new entrant to come in at that scale. They also need to integrate with the mobile telecommunications platform, which I think is quite complicated. So yeah, very unique in that. Some smaller competitors, as I mentioned. Probably the biggest competitor would be a mobile operator deciding to do this themselves. But even for them, I don't think they want that balance sheet risk.
All right, yes, you can continue.
Sorry, can I just add? I think Optasia's got a now business model, but then also my sense is like a Capitec or any one of the other disruptive banks. They will use that knowledge and that data to roll new products out. So I think that's the blue sky for Optasia. It's not just the current offering.
Especially considering most of these banks moving into that MVNO space as well. Chantal, I just want to speak to you about Weaver Fintech, which is a company we tend to forget about. Now, there's been a lot of calls for more regulation when it comes to that BNPL model. Are you concerned about that and how that might affect a company like Weaver Fintech?
Yeah, so I do think that when you're looking at fintech companies generally, a lot of them do bring quite disruptive technology to the market, and by disruptive it means it's new, right? It's a new offering. It's something that solves a problem that wasn't solved in the past, and in time, the regulator does tend to step in. I don't necessarily foresee it as something that stops that innovation from progressing, but it is something that these companies need to keep in the back of their minds, and I'm sure that they are doing that. So from a Weaver Fintech perspective, it's not something that I'm particularly worried about right now.
Okay.
I'm much more worried about the lack of liquidity in that share, to be honest.
Fair. All right, from fintech to sportswear brands / athleisure. Is athleisure still a thing though? You know, I know when I do my mall runs, I'm always in a gym set and some trainers, but I'm wondering if it's still a thing. Enough about me though. In that space, what is your preferred pick, Chantal? The viewer suggesting, or rather listing, Nike, Lululemon, and On Holdings.
Yeah, I mean, so just from my perspective, I think athleisure is still a thing, but not to the extent that it was in COVID or just post-COVID. I think consumers are becoming a lot more selective in terms of what they buy. I think fashionability is becoming a very important story again. So you would want to go with the brand that actually is the most fashion-forward brand, something that you don't necessarily just want to wear to lounge around the house with, but that you want to make a statement with. Now, Lululemon has had real issues because yoga pants are out and sweatpants are in, right? So that's been a bit of an issue for them. Also, the price points are exceptionally high, and there are a lot of copycats in that space. I wouldn't be investing in Lululemon currently. Nike also kind of fell out of favor from a fashionability perspective. Inventory's extremely stuffed, which results in gross margin pressure. They're working through that, but there could still be a little bit of pain for Nike. On, I actually don't know that well, but I know everyone loves On right now. So that's potentially something to explore a little bit further. My pick in that space is Adidas. I think they're executing exceptionally well. The three stripes, it's everywhere you look. Going into a World Cup year, I think they are going to see merchandise sales increase quite nicely. And yeah, I mean, I think that it just makes sense to me at the moment. The stock also doesn't look particularly expensive. But just as a final caveat on this, these things are extremely cyclical.
Yeah.
And one misstep or falling out of favor with your consumer results in massive gross margin pressure, because these guys are producing as if they'll grow forever. But invariably taste changes.
Let's get your take on that industry, Graeme. There's also the likes, what's been on my radar is a hooker that's owned by Deckers. Chantal also mentioned an Adidas that we didn't really touch on. And also just bringing in a key market like China, where we have been seeing consumption slowing down. Let's get your views on that industry.
I think Chantal summarized it well when she said it's not only cyclical. I think it's more fashion, and you go down a certain route and you suddenly you're out of favor. And if you just look, for example, at the challenges that Nike have been through. So right now, maybe it's on, but the reality is a year or two from now, on is off, and Nike is back. But the problem is when you're buying shares on relatively lofty multiples on the hope that they're going to deliver certain level of earnings growth, that earnings growth comes and goes, and that for me is the real problem. That when you're dealing with fashion, it's just so unpredictable. And I think you guys are throwing names around that I frankly hardly know, but the point is that there's just so much competition, and it's a model I think that I'd rather just sort of steer clear of. I think anything that is so vulnerable to change in trend, and if Kim Kardashian's no longer endorsing you, then your sales go down by 10%. That kind of model just doesn't appeal to me. But I'm old school.
All right, then let's get into your stock picks. Something that you like and that appeals to you, Graeme. Let's start with you. Where are you seeing opportunity at the moment?
I've been telling everybody to buy Absa for a long time, and sooner or later I'll be right. It actually has done well. I think over the last year it's up 20-odd%. But you look at a business like this where it's on a sub-7 PE, it's a dividend yield beating cash by a long way. If you're optimistic on South Africa, they'll do well. If you're looking for a moat, they'll do okay. So it's really, for me, on those kind of multiples, and I think Kenny, if they're coming in, it's going to be good for the business. So I think it's a business that is unloved, along with the banks generally, but particularly so. So for me, Absa at under 200 Rand, I actually cannot get my head around how the market continues to trade it at this ridiculously low level.
What about you, Chantal? I know you're a big punter of SA Inc. Are you sticking in that realm?
So, I mean, I think I've punted SA Inc. enough on this show. I'm actually going with an offshore stock today. So I was thinking about this AI story and question marks around CapEx and valuation and all the rest of it. And I'm looking to diversify my exposure away from just tech overseas. We've mentioned a few over the last few months that I really like, Galderma and Birkenstock. But today I'm going to go with Ferrari, that has the coolest ticker in the world, Race. And essentially you are buying a Veblen good, so it's a good that's appeal increases the more scarce the good is. They control their supply exceptionally well. I think that when you're looking at the disparity in terms of the experience of high income earners and middle and low income earners, high income earners are still in a very good spot. So I think that this company can perform well and is to a certain extent immune from the AI chaos that we are seeing currently. It's a physical good, and it's got a massive proven track record of delivering value to shareholders, and has come under a lot of pressure so far this year. So I think it's a good buying opportunity.
I've always said you might not be able to buy the Ferrari itself, as in the car, but you can at least get a share, right?
Yeah, and Hermes. Oh,
yes.
Yeah, I can't afford a Birkin, but I can maybe save to buy one Hermes share.
All right, let's leave it there. Chantal going with Ferrari and Graeme going with Absa. Thanks to my guest, Chantal Marx from FNB Wealth and Investments, and Graeme Körner from Körner Perspective. Do remember that Stockwatch pre-records on a Monday and Wednesday, that is, at 1 p.m. and is live at 6:30 on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right on Business Day TV.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.